In this video, we're going to talk about Section 351 transactions. So Section 351 is a provision of the U.S. tax code that allows you or a corporation or a group of investors to defer any gain or loss on appreciated or depreciated property when you're transferring that property to a corporation in exchange for that corporation's stock. So let me give you an example. It'll make it a little bit easier to understand. So let's say that you personally own a Ferris wheel, right? So if you don't know what a Ferris wheel is, it's this large thing that spins around and people climb into a little cage and go high up into the air. So let's say that this Ferris wheel, let's just say the adjusted basis, or to make it easier, the original cost that you paid for this Ferris wheel, let's say that that's $100,000. Now, that over time, the value of that Ferris wheel has gone up, and now it's worth a fair market value of $975,000. So you see it's appreciated. It's gone up in value at $875,000. So let's pretend that you want to form your own corporation and you want to call it Seven Flags Amusement Park. And so you're going to create this corporation and you're going to transfer the Ferris wheel. You're going to give the Ferris wheel to the corporation, right? So you're going to say, okay, I'm personally going to give the Ferris wheel that I own to the corporation, and in exchange for that, the corporation is going to give you stock, right? So the corporation is going to give you stock in the corporation. And let's say that that you're the only shareholder, and so let's say that there's 100 shares of the firm, of this new corporation, Seven Flags Amusement Park. So you're getting all 100 shares of Seven Flags Amusement Park. So you own 100% of this corporation in exchange for you giving this Ferris wheel to the corporation, right? And so basically Section 351 is going to allow you to defer that $875,000 in appreciation. And why is that the case? Well, it's basically this idea that there's a continuity of interest. And what continuity of interest is that really there's only been a change in the legal form of who is holding these assets, right? Because you basically give this Ferris wheel to the corporation, right? So you give it to the corporation, but you now own all 100 shares of the corporation. So in reality, you still have an interest in this Ferris wheel. So even though it's gone up $875,000 in value, you're not going to have to recognize any gain. You're not going to be taxed on that gain when you transfer the Ferris wheel to the corporation. Now, that's not tax forgiveness, because later, if you sell the stock or, the corporation sells the Ferris wheel and so forth, we'll get into that in future videos, there can be gain recognized, right? So it's tax deferral, not tax forgiveness. So I just want to make that clear. But Section 351 is really nice because you might be wanting to start that corporation and you say, hey, if I have to pay tax on an $875,000 gain, I don't know if I want to do that. So this is really taxpayer friendly, encourages people to be able to start corporations. And so there's 3 requirements in order to qualify for Section 351. And the first is that the transferor, in this case you in our example, but it could be a group of investors, could be whatever, when you transfer property, so services don't count. So if you're transferring services to a corporation, that's not going to count as a tax deferred transaction. Now, in some cases, you might transfer property and services, and we'll talk about that in a future video. But for right now, just understand that you have to be transferring property, not services, solely in exchange for the corporation stock. And so when I say solely, the idea is that you're giving the Ferris wheel, you're getting stock in Seven Flags Amusement Park. Now, this solely, there's also qualification for that, because there's this thing called boot. Let's say that the corporation also gave you some cash, right? Because it doesn't have to be that you're starting up a corporation. It could be a corporation that already existed and you're making this transfer and so forth. So if you're receiving something from the corporation other than stock, property or cash or something like that, you could, in some cases, still qualify for Section 351, but you might have to recognize some gain. And we'll talk about the rules for that in a future video. But for right now, just understand the basics. It's property that you are giving to the corporation in exchange for the corporation stock, and there are some exceptions that we'll talk about. Now, also, the third requirement of Section 351 to have this deferred gain or loss is that you have to have control You have to have control of the corporation immediately after the exchange is done with. So you might be thinking, well, what is control? Well, people usually call it 80% of vote in value. So what that is, if you actually go to section 368C of the tax code, you'll see it talks about how you have to own two things. You have to basically, after the transaction is done, immediately afterwards, you have to have at least 80% of the combined voting power of all the different classes of voting stock in the corporation, and then of all the other stocks, so like non-voting stock, you have to own at least 80%. And so these are the three requirements of Section 351, and in future videos, we're going to talk about things like boot and so forth, and when somebody's transferring property and services, so we'll talk about in future videos.